Are you ready to discover how a specialty chemicals powerhouse completely transformed its business and unlocked a massive earnings explosion? Welcome to an earnings breakdown of Acutaas Chemicals, where we decode a historic breakout fiscal year 2026, marked by a staggering 1,490 basis point margin miracle. The core agenda today is broken down into clear four-part story: the margin miracle, defining their recent quarterly and full-year performance; the core engine, driven by pharma and CDMO scaling; a fortress balance sheet packed with capital and cash flow; and future high-tech catalysts waiting in the battery and semiconductor runways. Looking closely at the fourth quarter of fiscal year 2026, the company is firing on all cylinders with unmatched top-line momentum, delivering 40.3% year-over-year revenue growth. Profits skyrocketed with a 114.1% year-over-year jump in quarterly profit after tax, coming in at a massive 134.30 crore rupees for the quarter, powered by structural pricing power that unlocked record margins. This relentless revenue scaling is highly structural, with zero reliance on one-off adjustments, driven entirely by underlying volume growth in advanced pharma intermediates. For the full year of fiscal year 2026, total revenue reached an outstanding 1,339.40 crore rupees, while the fourth quarter revenue alone contributed 432.80 crore rupees, marking a 10.1% increase quarter-over-quarter and a 40.3% jump year-over-year. This incredible operating leverage creates a massive profitability effect, as visualized by a climbing line chart where the EBITDA margin and tech margin outpace basic revenue growth. The full-year EBITDA reached 480.40 crore rupees, while the fourth quarter EBITDA margin hit an all-time high of 42.4%, expanding by 410 basis points compared to the previous quarter. Full-year profit after tax finalized at an impressive 356.40 crore rupees, driven by a massive reduction in input raw material mix ratios relative to net sales value, helping the company achieve an elite gross profit margin of 62.0% in the fourth quarter. A quick look at the green-shaded pie chart reveals a high-value shift in the revenue mix. Advanced pharma has become the primary growth engine, surging 37.5% year-over-year to make up 87.7% of total revenue, which translates to 1,174.1 crore rupees. Meanwhile, commodity chemicals represent an intentional strategic reduction, dipping 2.1% year-over-year to 11.2% of the mix, or 149.5 crore rupees, while semiconductor chemicals stand at an early-stage rollout of 1.2%, worth 15.7 crore rupees, and battery chemicals sit at 0% as they await full commercialization. This transition highlights the brilliant Acutaas playbook of moving up the value chain. They are intentionally shrinking their legacy commodity chemicals business, which is plagued by volatile pricing and low margins, to anchor themselves firmly in advanced pharma and CDMO, boasting a 42.4% margin, optimal utilization of their Ankleshwar plant, and strong tailwinds from chronic therapies. Their future options target massive addressable markets in semiconductors and battery chemicals, where Phase 1 has already been validated by global accounts. Financially, the company boasts a pristine, bulletproof balance sheet, highlighted by a bright green graphic. Acutaas holds 215.60 crore rupees in cash and equivalents, leaving them with a substantial net cash surplus of 189.30 crore rupees after accounting for a tiny total debt of 35.60 crore rupees, resulting in an incredibly low debt-to-equity ratio of just 0.02 times, while their net worth grew organically to 1,710.80 crore rupees, strictly via retained earnings, to provide an exceptional capital cushion. This financial strength translates directly into elite capital allocation metrics, shown on screen via two glowing green dials. The return on equity expanded remarkably to 32.5%, up from 15.1% in fiscal year 2025, while the return on capital employed hit 39.3%, climbing from 19.1% in the prior year, proving that heavy margin expansion doubled their return ratios in a single year, and their exceptional leverage comfort provides the freedom for seamless future expansions. They are already sowing the seeds for that future with a 332.40 crore rupee capital work-in-progress pipeline. This includes battery additives at Jagadia, where Phase 1 is complete and validated by more than 5 global accounts, while Phase 2 is actively underway, and semiconductor chemicals through IndyChem Incorporated, building critical infrastructure in South Korea to capture global supply chain diversification, aligning their strategic capital spending perfectly with high-tech global megatrends.
A stringent forensic check confirms these earnings are entirely authentic. The relationship between profit after tax and cash flow from operations shows a healthy cash conversion that is fully aligned with historical working capital cycles. One-off adjustments are non-existent, meaning 100% of reported earnings are driven purely by core business operations. Working capital is scaling safely, with receivables at 362.60 crore rupees and inventory growing proportionally to their 40+% revenue growth. And CapEx execution is flawless, as the Ankleshwar facility is fully operational and the new high-tech lines are progressing on schedule without causing any external financing stress. Looking at valuation, is the market pricing in perfection? The company currently commands a market capitalization of 20,948 crore rupees, trading at a trailing price-to-earnings multiple of 58.7 times and an enterprise value to EBITDA multiple of 43.42 times. The positives driving this premium include industry-leading margins of 42.4% and diversified, high-tech future growth drivers across semiconductors and batteries, though investors must consider risks like high sector concentration, given that pharma makes up over 87% of the business, alongside execution risks regarding their South Korean CapEx joint venture.
Turning to the road ahead, management's official guidance for fiscal year 2027 targets a strong 25% top-line expansion. This clear visibility is heavily driven by the upcoming commercialization of their battery and semiconductor lines, alongside the continued structural optimization of their Ankleshwar CDMO capacities, giving an overall verdict of an aggressively constructive stance for the next 12 months. What's your take on Acutaas Chemicals? Let us know in the comments. And if you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.